What's up, everybody? Good morning. Already a neat little push this morning on NASDAQ. Hit that lower D band about maybe, let's see, an hour ago. That wraps up the end of the day. Day trading. Typically markets move that far. You have a little bit of a, choppy, crazy random day. We'll see what happens. Oh, where's the transition? That was a hard cut. What's up? Good morning. All right, let's get started here. What's up, friends? Morning. What's up, John? Bearing Bulls. What's up? Good morning. Hey, Lee MK. What's up? Where you guys at? Ready yet? Yeah. Coming soon. 51.80. Oh, sorry, 51.79. Some change. The upper is going to be closer to 52.44. I'm getting all this out of the way here. It's NQ that touched in the morning, yeah. All right, so we just got our big major marketplace launch, our UI, new UI launch, everything done today. It's looking pretty tidy, cleaning up a few little bugs on it, but I might give you guys a sneak peek either today, maybe a little bit later. Run into a Zoom call, kind of show you what it's all about. Looking good here, so liquidity maps pop up. In the meantime, let's check out the news. What's going on here? Nothing crazy. Williams and Barkin speaking today, but nothing. Loan officer survey, interesting data point. Nothing really big. It's a really light week. Earnings is all we have, so I'm keeping it easy this morning. Disney came out, pretty nasty little run here. 10% drop. They beat and they still won. They still dropped on the beat. Double checking. That's it. Earnings. Big earnings this week. Next. Okay, cool. Pardon me. All right, market's looking stable-ish this morning, despite DD band tap. The alerts aren't because the DD bands aren't populating the data yet. That's the thing. We need to get that. That's gonna be fixed this week. We're gonna work on that one. Come on. So bull zone push to half gap here to here. Negative resilience is downward pressure. Let me restart my pencil tool. So it's got bull pressure, but very limited upside today. So I'm kind of gonna wait on this one. So normally what happens is when you get a DD band tap on NASDAQ, that was right here. The market typically becomes random from that point. And so it's a little hard to trade. So you're very careful. Today we have two different conflicting resiliences, right? So minus 29 is resistance from there. So it's likely going to have resistance here. For sure, resistance here. You're going to have upward pressure from here maybe the half gap on the BLU. Rest. So the market is likely to want to trade lower. This is my call for today. With that being positive, it's likely to hold for it. So tight, clean day today. Or sorry, tight, not clean day today. And draw this like in a different color. See what I'm saying? You see what I'm showing you here? This is not the dip to buy. A terrible Yoda impression. Get here. So kind of range bound inside of here. 516, 514 on the lower end of things. Here, kind of a question. What's going to happen? Probability of breaking through. Let's say this is on the S&P, about 5,200. Rare case. Unless resilience takes a change. Hey, good morning. What's up, y'all? Good morning. Yeah, and that's a kind of a similar boat. Let's look at sort of monthly maps really quick. All right, so no trade set up for me today. I don't like it. Let's check out the monthly map. The map's just looking stable and bullish over the long haul, so this is good. The way that you read monthly maps, if you guys aren't familiar, link up the cheat sheet here for you. There are these cheat sheets in our Discord for those of you that are part of our program that are learning this stuff. The way that you read it, just a little bigger. Is that you have a downward kind of slope. Bottom of these bull zones sloping down like this. You remember from to here. Let me go ahead and so here. Forget these lines on the chart. Let's draw some new ones. Here. So bulls are longing more over time. So this dip is getting bought over time. So whatever happens in here, we're supporting, and the rally continues. So it's not bear market anymore. DD band is 0.75. You know, the selling we had for like a month or less, that's pretty much done with. But today is just kind of one of those days of it to kind of be careful. Maybe the rare thing is what happens. One thing I'm not doing is going to be shorting this. Greater bull market is still here. Top of the bear zones, which is the top of these light gray boxes, also sloping down still. So when you see bulls are longing more, which is the long side of the market, accumulating more longs as you come further out in time, it's more people longing, more longing pressure from in the money calls and bull zones. The bear side sloping down is bears exiting positions, which means people that are short the market are becoming less short. They're squeezing. The shorts are covering, longs are buying. It's a twofold bull wave up. So the market is bullish from here. Easy to see that. Now, does that mean bullish today? This is kind of possible, but like the rare thing is that today's probably not the day that's going to go. It might not happen today. It might happen towards the end of the day, maybe at the end, last couple hours, typically is when you get those surprise turns. While the greater market is bullish, today's structure is not. Today's structure is kind of, you know, still stuck at the bottom, and earnings is affecting a lot of the movement. But if we talk about all the things about the greater market, right? You look at a couple of things, and that's really how I do my full bias. So greater bull market, greater market. This is it. We have a whole video on this greater market. Okay, number one is DD bands. I'm sorry. Number one is monthly map. It shows bullish for months. So this is we're bottoming out somewhere in here. We're bottoming somewhere in here over the monthly scale. So this monthly dip is probably done unless something else happens. No catalyst for this week, right? Nothing big in the news, just earnings. So it's not going to be a lot of big market movement. Second is trading above or below MHP. So SPY greater than MHP. So today, in general, that is gamma positive on monthlies. So the dealer balance is to the positive side based on gamma. So gamma hedging is going to produce positive delta hedging, longer pressure, harder than shorter pressure. So in general, on the long scale of things, just left to its own with no trading, the market's just going to try to float higher as we get closer to expiration, which is about a week from this Friday. 2 Fridays from now. Number 3, DD bands. DD, said that twice. DD ratio, 0.77. Greater than half is 50%. The majority of the stocks market cap is in bull zone. Stocks themselves are bullish. The index options show bullish. Stocks show bull structure. Or sorry, bullish. Index hedging structure is bullish. So monthly maps show bullish over time. Check, check, check. Greater market equals bullish. Okay, and this is why I do this every day. I call my greater market analysis. This is my sentiment. So in general, sentiment is my sentiment is bullish over the bigger scale. So that's all I know. So in general, I'm bullish. If I'm swing trading, I'm bullish. Today might not be a bull day inside of this. Today might still be a choppy day inside of it. But you'll see how I do my analysis. So far, while today being, I kind of do that a little cleaner. While today is not necessarily the strongest of the bull days, I look for those bull surprise moves to kind of kick everything into gear. It's kind of like drawing this again. Liquidity map, which is today's day trading, has support here. Res is pushing down there. Res clearly open in bear zone, likely close in bear zone more than 75% of the time. So this is high of the day expected. This is the ultra rare. We go into a bull zone from here without a catalyst, unlikely to maybe until the end of the day. Even if this rallies and breaks out, we know bear side resistance is there. It's opening in bear zone. So typically you open in a zone, you close in the same zone under all conditions more than 75% of the time. So there you go. MHP is likely to hold with the 33, which on a scale of the MHP resilience is the tiebreaker at this orange line. So chances are we are ultimately supporting there. So low a day. And again, the ultra rare is breaking down here. So 514 is likely to hold, 517 is likely to resist, and we're stuck inside of there today. Do you have any questions about how we read the market every morning? That's typically how you do it. That's what we teach at the liquidity map institution. So I go into X-Men Academy, learning how to be a superhero. We teach you how to be a superhero in risk management. Would you long for MHP if we get there? Typically, I always do. Without a catalyst, I don't bet the MHP breaks. Now you have to watch both S&P and NASDAQ together for the same kind of. Let's look at NASDAQ, just to make sure that NASDAQ's not offering any strange clues as well. And see, NASDAQ already has that support kind of there. So if S&P gets to here, NASDAQ will have likely broken it. So it's kind of a toss-up. The S&P usually drives the market rather than the NASDAQ. So just be careful. I typically do, yeah. I always long off MHP or short off MHP from below. So I never really bet on MHP breaks. It is one of the rarer cases. And without an event and with the greater bull market sentiment being bullish, it would be a rare thing, ultra rare for MHP to break because the monthly sentiment is bullish across the board. Stocks, index, and the S&P zone hedging, the S&P zone structure. So it breaking MHP without a catalyst, which you have nothing news next couple of days to be like the ultra rare. Cool. All right. So I think that's a great place to long off of. So we're seeing we have this kind of, today, like if I were to redraw what I was going to draw, get this is kind of like what's expected. Hard to say where we end up. And typically any kind of market changing move, it's going to continue the trend or break out of this range. Like the range we're in today. Typically the breakouts were going to happen likely closer to the end of the day. Closer to earnings. Is there a big bond auction today? I don't know. Maybe? Three and 6 month bill auction today. Yeah, so it could create some movement. Analyzing the VIX here really quick. I'm still trading below triple B on the VIX, so there's no strange VIX hedging or anything. We're going to be trading pretty tight on pivots. The liquidity map on VIX is actually bullish in general, but there is no bull pivot for it to bounce off of. So where we are right now, VIX is kind of like safely sitting still. As volatility contains itself, this is likely to not collapse unless we get something crazy. So if VIX is breaking hedge pressure and continuing to go, we'll actually know that that's going to be the sign that we will go lower. So like I said, we're still like kind of in this range, in the middle of the range. I hate trading in the middle of the range. You know me, I like to find those excursions, get that high probability setup. Like, ooh. So, big new marketplace release. Very much excited about playing with it. We're patching up a few little bugs here, which means is that we can get back to like repairing DD bands and stuff because the push is pretty much done to get the stuff we need to rush out there. You're seeing tenure today. Am I just eating paint chips? Tuesday, May 7th. Well, oh, there we go. Why am I on the wrong day? Hold on. What? Oh, you know what? Yeah, no, I am on the wrong day. All morning I'm looking at Monday. Okay. What? Don't listen to me, guys. This is my brain like looks at this and was like, oh, we don't see the, yeah, so these people aren't speaking today. This was Monday. Today is probably Wednesday. Hey guys, I'm officially fired. All right. Anybody want to take my place? I quit. I'm done. It's time to retire. Okay, here we go. There we go. Today is Wednesday. It's no longer Monday. Just FYI. I was like that. Yeah, that kind of seems odd. So yeah, today 10 year is a big one. Yeah, so that's at noon. That's much better, you guys. So we might get the bump we want closer to noon. What else other than that? Colin speaks. Not have dark blue shirts. Hey, I also have black shirts too. My girlfriend, she loves my Mark Zuckerberg wardrobe. I have essentially a shirt that I love, and I have it in like every color they make it. But not only that, I have like 6 or 7 of each one. So like I have this like this V-neck John Barbados shirt. I love them. It's my t-shirts I wear. And my dark blue one, like I literally have like 6 of them. Like Mark Zuckerberg's wardrobe is just like that gray shirt he always wears. That you open his closet, there's like 50 of them. And when you like what you like, I recently bought a couple pink ones. I changed it up a little bit. I think okay, here we're at the rare boundary. Wait, hold on, that's not what the rare boundary is. Let me draw where that would actually be. Stretch that out. Wait, no, squish that down. Let's stretch about here. I'm gonna try to make this by scale. That's more appropriate. There's your bear zone. There's your MHP. So we're kind of ranged inside of here. So monthly sentiment's bullish over the time frame. Like I said, I'm not shorting in here. Possible long pressure from here. Resilience is negative. You know, it's likely to have some struggle in here. And, I'd be looking to fight some kind of dip lower towards the end of the day and scoop it up. Right, dynamics bounce in MQ. Yep, absolutely. It's pulling back a little bit too. So market's pretty stable. I do like it. I don't hate it. Oh man, just a couple more things. Doing a quick little testing of the new marketplace look and feel. It's beautiful and it's clean. Well, okay. It looks very nice in the new update. Well, pushing in a new update live in a second. On earnings and monthly map setups, I haven't, but I think that's a great idea. One of my super excited, projects coming after, the big marketplace release, when we start getting some momentum there, is to come back and revisit the platform to start building modules for it. The backtest module is like the next big thing we want to do. So after we get console out, coding language out, backtest is very important for the premium version of the platform. Yeah. I'm just doing a quickie bug check and some of the marketplace stuff. Ooh. We tried to play earnings chat, it seemed to predict Palantir, but it seemed to predict Palantir and Shop. This is a comment purely based on quick glance, not actually G. Let's take a look at it. I mean, it does reflect the structure of the market around earnings. I mean, that is the structure leading up into the earnings. You have the options pretty much. Let's see what we got. Yeah, so like leading up into it, Shopify is bearish. You got bull side selling, bear side strengthening. So leading into earnings, there was the dip. That's actually pretty nice. You might be onto something. Doesn't not make sense. And then of course, Palantir, bull side selling, bear side strong. So that did drop. That's really neat to see. Yeah. So let's see what Disney did. Let's see what. Poor old Disney used to be one of my favorite stocks, you know. Same thing. Bull side selling, bear side strong. Hey, maybe you're onto something. Oh, okay. 3 for 3. Let's try. Where's my calendar?
Meet Asana, a work management platform that helps.
What do we have today? Toyota. Farm. What do you have Thursday? You're on something there. I'm just looking for any pop stocks. Let's just try something that's in the vicinity. Toyota's all over the place. Bull side strong, bear side strong. So this one's inconclusive. So they're crisscrossing. They crisscross, then the market's tight, liquid. That's not really directional. You got people mixed feelings. I didn't even think of this. Might be onto something. Options on this guy. Surely we have liquidity. Oh, we have no data for this one. Maybe we'll pick it up tomorrow. It's a stock nobody's ever. Oh, there it is. Okay. Bull side weak, bear side strong. Okay, so we'll see tomorrow. Remind me, ARM. Are we looking to sell off today? That's interesting to see, and we'll see how that works. I do like that idea. I mean, it does make sense. The structure's for weeks out from now. This is including earnings. Interesting. Okay. I love it. We're back to that. Nice little spot over here in the S&P. Walking up to that bear zone. So this is kind of that resistance today. It'd be the ultra rare to break and keep going. 518 and continue to go. So the upward pressure is here. Resilience is still not super strong. So while it is trying to repair, the index is moving first. I don't expect a sell off, but at the end of the day, no rally from here. Nice and tight trade. I didn't want to take it from here because it was a small, tiny little move. I wanted to take a long off of MHP, so it'd be nice to be open and dipped, take a long from there. So that's probably the extent of the bull move that's patternable. Everything else is kind of going to be hard to predict. If I was long from here to here, I would be cutting out probably about now, taking profits right up in here and then just letting it fizzle out, just letting it go about my day and just forget about it. What's up, Cheyenne? Good morning. Morning. Boy. Yeah, our tools are like on point. I love it. Hey Randolph, how's it going? Let me check on what you're asking. Thank you here. We're looking to touch the bottom of the bear zone with negative res. We're looking at downside from here. So I wouldn't say looking at downside. I would just be saying not looking at upside. The way that I like to look at it is, what is going on with my graphic here? Hold on. Great question. In this illiquidity pocket, like with that bullish pressure, well, okay, let me start over. The answer is I'm not typically shorting from there, but if I was long, that's the predictable trade and I'd be down with my long. So if I'm looking for downside, the answer is probably. It's rarer to break and go, but I don't say when people say like, are you looking for downside? Would I be looking to short it? The answer is probably not, even though it is probably the end of the bull move. You can see there is resistance there. It's just the end of the predictable bull side. So while the pressure and everything is still up and the bull market's still there, longing from here to here is the only predictable thing. So it likely could just like fizzle out. It could fight all day and then break and go, but this is not a bearish setup. But the answer in your question, Randolph, does that make sense? So looking at, there is potential downside for me to not really want to be long right up here. I'd exit my long if I was long. But because there is likely smaller probability that it does sell off, there's really nothing to predict on a short side setup for me. So I have a theory that I only short off of hedge pressures from below. Those are the only times I do short. So longing from here, Xing out. And so the market is likely still got bullish pressure from here, but it could have maybe a down push or whatever. But normally if I was shorting, I would go from like here to the next resistance. That's it. Shorting against a bull wave, I take a very small play if I ever do. But yeah. So with negative resilience, is there possible downside? It's possible that this does go to here. It is all possible. The answer is yes. So because of resilience going through the box, the answer to your question is that is correct. This is not bearish liquidity map. As you see, liquidity map, all pressures are kind of pointing up. The liquidity pocket does cap out typically at the bear zone, and it's the first resistance you get. You're going to say there's a possibility, the probability is higher, with that being negative, that it does go down in here. Yep. But I still have a hard time, even though there is potential downside, it just gets me away from my long. If I see this and we had other bear signs, I would love to short this, but all the signs in general don't really point to any bearishness yet. So while it is resistance to the bull move, you see how about like the last 20 minutes, it's just kind of stopped moving higher. If I were to short it, it would be a very, very small scalp somewhere inside of here because I know that it's still got big support right there. So do I expect downside a little bit? Yeah. How much is hard to say because everything else underneath it is bullish. And it could be that this is all that the downside we get. Could it sell off to here? Absolutely it could. So I think of it like, okay, well, if resilience is negative and pulls it down lower, it's just going to grab me closer to that support I wanted. But you see the effects of exactly what you said right here, Randolph, 100%. This is that downside. And right now it's not much. But you can see how the bull momentum is starting to hit that resistance, just like you said. Just I don't have a short entry to act on it. Now, some people, the trick of when you're in the upper side of the box and you want to short for resilience to take you to the lower side of the box, people scalped out a lot, but where do you scalp from? If you were to scalp from it, this is the place to scalp from because that is the first resistance in the way. So here and here is a scalp back to half gap, and that's basically all I would do against the greater bull push. There's probably a wave in here to bring us to test somewhere in there. So this, for instance, is like maybe 5 or 6, 0.5 or 0.6 points in NASDAQ. Why the bond auctions can affect the market so much? Yeah. So as you know, the typical investor, I would say, like you yourself typically buy stocks. There's what most people tend to invest in stocks and maybe like mutual funds, ETFs and such. But your portfolio managers, right, you know, their investment strategy typically is a well-rounded strategy of assets. So you don't different classes of assets they like to diversify. So you don't really see for example, your 401k, the managers don't really short anything. It's not a big, you know, it's not a big strategy to short something on a longer term time frame, right? Most typically the stock market always goes up. So a good 401k or mutual fund manager, their job is to long all the things. Short, because over 30 or 40 or 50 years time frame of your investment, the index goes up. So a diversified stock portfolio typically should always go up. While some of the companies will go down, the overall stock market always goes up, right? So that's a good strategy people have. And when the stock market isn't going up, or when there's risk to the stock market going up, fund managers, instead of putting their money to cash and having it lose to inflation, which the Fed typically targets about 2% a year, right? Or 2% a year is their target. So imagine this is why it works so much. So institutional money, institutional funds. This is going to be like 401k, such, mutual fund, etc. Pension plans, whatever, tend to just long stuff. So when periods of market up, they like to long equities. When there's risk there and like the market is crashing, let's say like 1 to 2 year crash or bear market, they don't take your 401k and short it. What they do is they keep throwing money at it as it dips. You'll see that when markets collapse, institutional funds buy the dip, right? But they need money to do that. And so what they do to kind of like cost basis average into a lower price for all the stocks in your portfolio, knowing that there's a risk of this happening, they tend to move some of their money away from equities, like selling. An example, say if they sell near the top, because they say, okay, all forecasts are saying we're probably coming down for a year or two. So let's sell into cash. Okay, so cool. So instead of just holding cash while the market's pulling back, we all know that this is time, right? Your cash loses 2% a year due to inflation. You understand that so far? So if they were to just sell at the top of the market, they made 8% this year, and they sit in cash for 2 years, they're going to lose 4% of it because inflation just melts cash value away. So to battle inflation, what they tend to do is diversify from equities into fixed income, which are treasury bonds, an example, that have fixed yields, maturities. So if you have a bond that has 3% yield over some time frame, 3% yield per year, then clearly it's free money on top of cash. Cash is going to lose 2% a year. So 3% a year not only beats inflation, but has an extra percent of gain. So when you take the yield, and this is just a quick and easy way to do it, yield minus inflation equals, we'll just say the net. The net is positive. They're getting free money. So if they're making 10% a year on a bull stock market, moving to cash, they're going to lose 2% on all that cash every year. But they're going to gain 1% net of free money. It's not 10% in the stock market like it was, but it's certainly not losing money. Does this make sense so far? Opportune moments? So the idea is that when people start shifting some of their money from equities and going more into fixed income, then you're gonna see, then why are the auctions so important? Well, because the auctions show the supply and demand of that yield. So an example is if more people want, if this is free money and markets are crashing, then everybody wants to buy this. So when everyone buys something, the premiums go up. And when the premiums go up and the demand for something is high, the yield goes down. So if enough people are buying this thing at 3% yield on the maturity date, then as the price of this thing goes up because the demand for it is higher, the yield's going to start coming down. And at some point, that yield is going to be, 1.9%. The yield returns less than inflation. So you're still losing slightly amount of money. So maybe people may not want it as much if they're more bullish equities and less care about safety, because even the bond loses money. It doesn't beat inflation. So the supply and demand of bonds are a battle between inflation and the yield versus the risk of the market selling off and how diversified portfolio managers are from equities into fixed income. Maybe it's like 90% equities, 10% fixed in a bull market. Maybe the strategy is 70% equities and 30% fixed in a bear market. And if that 30% fixed is not producing yields to beat inflation, then they're better off sitting in cash. Why buy something that even loses money faster than inflation? Why park my money in something that's going to pay out? Well, I mean, even that's better. Actually, that's better than losing 2%. Gaining 1.9 is still there. The net is still a loss. But what if you see what I'm saying? Where there's a balancing act, they may not want that as part of their strategy. So the auction, when you have price of something set, the yield of something is set. So you have yields and premiums working together, the supply and demand of bonds. So if you perceive that people are rushing into buying bonds, then there's a couple of things. Number one is they're beating inflation and the risk of equities is too high at this point. If nobody wants the bonds, then people are going to sit in cash. But people don't sit in cash in a high inflation environment like we have. So if people don't want the bonds, it means they really want stocks. So you have to look at the environment. In this environment, again, cash, toxic. There's a high inflation, okay, higher inflation. We're not below 2% for sure. Equities, hot, right? Markets near all-time highs. So typically, if cash, an alternative scenario, if cash was king, a low inflation environment, say inflation, example, inflation is 1%. Then cash is king when stocks are no longer hot. If equities markets are selling off and bond markets aren't rallying, people could just be moving to cash. They don't want the bonds, they don't want the stocks, they just want the cash because low inflation. Let's just sit in cash till things stabilize. But that's not what we have. In a high inflation environment, nobody wants cash, right? So equities are slowing down and selling off. You expect in a high inflationary environment, bonds to be hot. Because there's no alternative. Cash is terrible. If you don't want stocks in high inflation environment, you will be in bonds. You will not have your cash sitting in cash. So the auction will reveal in this environment, they're very transparent, which is why they're very actionable in high inflationary environments. We usually ignore bond auctions, don't we, as traders? We don't think about it. because we don't really live in high inflationary environments all the time, at least in my time frame. So bond auctions were just a thing that, like, whatever, bonds are those weird things that old people trade. What I used to tell myself when I was a young trader, bonds. But in a high inflationary environment, bonds are one of the biggest reveal of the stock market. If the auction reveals nobody wants bonds in high inflation environment, they don't want cash, and if they don't want bonds, what's left? Tell me what the answer is. As the market is pulling back, if we don't see money flowing into bonds, it means people want stocks, stockities, right? So that's why it's very actionable, this environment. Yeah, so that's it. So you're kind of looking at the bond auction to say, nobody's buying bonds. Okay, well, bull market, structure's bullish, we just pulled back. Equities are still hot. So if those premiums are lowering and those yields are going up, because, or, you know, when yields go up, it's because premiums are lowering. Premiums are lowering, it means people are not buying something or they're selling something. So people exiting bonds, that cash is going to go somewhere back into stocks. So in an inflationary environment, bond auctions are a very high reveal as to demand for equities, because in high inflationary environment, the cash, stock, bond, I did stocks with an X, bond, triangle, inflationary environment, you just eliminate cash. Bonds are typically going to have some kind of yield on them. You're at 4, 5, 6, 10%. Cash is just something nobody wants. So at this point, you just have an A and B comparison. If they don't want bonds, they want stocks. If they don't want stocks, they want bonds. And the stock market's telling you the supply and demand for stock. The bond auction telling you the supply and demand for bonds. So at this point, it's one or the other. If the bond auction prices are going up and yields are coming down, it means the people that were selling are moving money into bonds. It's more cautionary. So it's a stronger correlation when one goes up, one goes down. When you're inflation. When you're not inflation, however, it gets a little messier and harder to read. So typically, you don't see the bond auctions being as actually happening. But in this environment, right? So we started pulling back. You haven't seen those bond auctions create intraday movement, right? Like the bond auction come out, especially the 10-year. You have your ones that are typically used for recessionary predictions, right? People, the 10-year and the 2-year are probably the most important, because 2-year is like your typical bear cycle in a bull market. Your 10-year is your short-term credit cycle, which every 10 years you tend to have a short-term credit cycle, right? 8, 7 to 10 years. Markets credit cycles down. So the 10 and 2-year yield curve inversion is typically a sign of bear market. People always talk about that one. So those two are very, very important telltale signs of people saying, you know what? Fuck inflation. I don't care. The market's going to be bearish for 2 years. We need to go in those bonds. Who cares what the yields are? We need to get into them now. And so the 10 and 2-year are very important. They're all important, but they all can create some activity. Now, again, just like any event, the news comes out, doesn't necessarily predict the action, but as an investor, your sentiment matches that. You think, okay, well, nobody wants the bonds, and clearly they want the stocks. It doesn't mean they want the stocks right now. It doesn't mean, okay, the bond auction shows something different. Okay, the stock market's going to crash. It just means in general, people want. It doesn't mean money managers are moving all of their money, Wednesday at noon. It just means that the general sentiment is there for money fluxing backwards. So if I was bear and the bond auction doesn't show people running to fixed income, I'd probably get out of my bearish equities position, because I'll know that people are not fleeing the stock market, which is what I need for a sell-off to happen. So you make those clarifications, then you'll be pretty good at seeing what this is. So it's an actionable thing, just like anything else. It's pretty random on the stock market. People try to predict and trade off of those auctions and different stocks, and they may or may not move the market, but you see that it becomes actionable because people are shifting money around, betting on what happens. it is bullish for stocks in a weak inflationary environment if there is no demand for bonds. It's hard to say if there's no demand for bonds in a weak inflationary environment. Without inflation, people could be moving money to cash. So it's like when you don't have inflation, you can say that, well, we don't know if, you know, cash is still king at this point. Maybe people are just moving to cash, and that you can't see. So in the triangle, if you can isolate one as being toxic, then people don't want it. If the bear market, if the market's crashing, okay, stocks are toxic then. So then you expect people to flood to bonds. Well, at some point the bonds become worthless, because the people, so many people buy the bonds, the yields go to nothing. And so then people don't want the bonds anymore. Then they'll go to cash. So the stock market's toxic. Then of the triangle, you've isolated bonds and cash. So the bond market can just tell you people probably going to cash. So an example, if the market's collapsing and bond yields go to zero, which means premium's gone way up because everybody is flooded to bonds at that point, then nobody's going to buy the bonds, and the auction comes out and nobody bought any, nobody won anything, nothing changed. So then you can't say, ooh, the stock market's going to turn around, because the stock market's still toxic in a market crash. So then you can make the justification, people are going to move to cash. So when you isolate one, you can make the determination of inverse proportional between the other two. So if the bond market has no activity in a low inflationary environment, then people are likely selling stocks and moving to cash, waiting for a dip to buy back stocks. Easy as that. So the ideally is that inflation is a cool thought process that can eliminate cash as a trigger. I mean, cash is a part of the triangle. Stock market crash can eliminate stock as part of the triangle. Yield plunging below inflation per year on a bond can remove bonds from the equation. So those three parts of the triangle, that's how I always perceived it. But is it actionable as a trader? It's hard to say because, you know, it's each investor still has their own risk profile despite the generic, you know, relationship I made, which is a really strong relationship, as the bulk of people will be thinking that way. Doesn't mean people are acting at that moment in time. You maybe have nobody trading that time, and a couple of firms forget the bond auction, sell their stock anyways. Market's going to come down despite what you think's going to happen. So usually those catalysts are kind of random. Those events are kind of random, sorry. But they do move the market. So you always, what you want to do is be kind of out of the way when you know we're sensitive to bond auction, which is now. Inflationary environment means the sensitivity to these bond auctions, especially the 10 and 2 year, is up. So you would probably not want to hold a trade through that auction knowing that it's predictable. You're likely going to get the same thing you get at CPI or Fed releases. Just market's going to randomly start moving quickly. It'll be sensitive. And so somebody asked today, like, is there some downside here? And I said, yes, but I'm not shorting. That's why the rarer thing happened. There is no short setup against the bull liquidity map. That's why I was not saying there was a short. If there's a short, it's very short-lived, from like here to maybe there, and I don't take it. And we had a little push off of that. Now the S&P hit its bear zone. There's likely resistance from here, but again, it's the same story. Resilience is still negative. It's likely very short-lived. And yeah, so this is why I don't short. I only short against MHP and HP from the bottom. I don't short bear zone. I don't short bear zone. If DD ratio is bullish, I don't short bear zone. I would short bear zone if this ratio was bearish though. Cool, you guys' explanations good. All right, well that's it. I gotta bounce. This is the end of the day for me today. I love helping you guys learn some stuff. Generalization like that is pretty cool to make. So just be careful when that spot auction today. Market's gonna move pretty quick. Probably. Wait. What's up, Ed? What up? Oh, sorry, bud. Could you go over when we would play the DD bands rejection? Sure. So, we haven't correlated the DD ratio to DD bands yet, but anytime you're around, other than the float, anytime you're around here, so it's correlated. We haven't back tested the probabilities. So anytime you're trading close to here in DD ratio, We've correlated, we just haven't back tested it yet. It just, we know that it's strong. DD ratio greater than 0.5. Then it's going to try to resist touching the lower band. So playing lower DD band when ratio is greater than half is a long. On the upper side, if DD ratio is less than half, it's going to try to not touch that line either. We call it the float. So playing the DD ratio off of the band is the typical thing. Today the ratio was high. NASDAQ literally was playing in its DD band, right? So NASDAQ was hitting this in the pre-market, and then market opens, tries to dip, ratio is greater than half, it pulls away from the band. Does that make sense, Edward? So if you did NASDAQ's band was like right up against the candle, pretending this is NASDAQ. See how it just, it's kind of like hedging away from it. Yeah. So that's the only time we play bands like that. Now the probability, we haven't done the back test of it yet, but the probability is high. It's very actionable. It's probably 70, 80, 90%. So if you get close to the band at the bottom and the ratio is really strong, 70, 80, most of us always long, for sure. Cool. All right, y'all. See y'all later. Love you guys. I'll see y'all tomorrow.